Hi, good morning, and we now reach the research section of the presentation, which if it was on Zoom would be the cue for you to turn your cameras off and go make a cup of tea. But bear with me today as we cover the UK market outlook, both in terms of our global economic house view and what we expect to happen with all of the UK property sectors over the course of this year and the slightly shorter outlook as well. So let's start off with that economic overview, therefore. And this is our house view for global GDP growth. You'll notice in the very bottom left-hand corner, this is source CBRE Research January. Now, a lot has happened since January, and this obviously doesn't reflect the ongoing issues that we have between Russia and the Ukraine. But the truth is that we've had an unbelievable amount of uncertainty in recent times, and making these GDP forecasts is a really hard job for our forecasting team. Now, that said, the outlook for UK economic growth is really very positive. Having seen a world-leading fall in GDP in 2020, we recovered quite sharply in 2021 with 7.5% growth, and this year and next year expected to see amongst the highest growth of anywhere in the world. And why is that important for you? Well, we know that there's a link between property market performance and GDP growth, and to have 2 years of such strong economic growth should really spell opportunity. Well, that's the good news. If you look at this on an average basis, and that's at the bottom, taking in the whole of the COVID period plus the recovery to the end of 2023, you'll see that really averages out as pretty much the same as the rest of Europe. So an average of 1.2% per annum over those years. Looking at some of the shorter term indicators that we monitor closely when we're looking at economic performance, moving from left to right here. First is the Google mobility stats for Belfast specifically in this instance. And you can see that when those lockdowns finish, things really bounce back quite sharply, especially for the retail and the recreation sectors. And really just leaning on something that Brian says, people have been more willing to go to bars and clubs and shops than they have to offices so far. And that's why the darker blue line is somewhat lagging. But this gives us cause for optimism. We don't think there'll be another lockdown, and those lines should gradually get back to that pre-COVID normal before too long. The composite PMI, so this is a business confidence measure, anything above 50 indicates that the economy is expanding. And you'll see that that number has been above 50 now for 11 months in a row. So really underpinning those GDP growth forecasts that I showed on the first slide. Finally, onto the retail sales. And whilst retail sales did take a dip in the most recently released numbers, they do remain above their pre-COVID levels. The UK consumer can be relied upon to spend its money and to keep the economy going, and our economy is dominated by the consumer, so this is really important. Now, I can't talk about the economy without talking about the issue of the day, and this is inflation. And again, this is the same set of forecasts that were done pre-Ukraine crisis, but the shape is likely to be somewhat similar, albeit we probably now think inflation will get higher than these forecasts suggest. Our view is that inflation is high now, it will get higher, but the causes of the increase in inflation are relatively transitory. These are temporary factors. For example, the year-on-year inflation in second-hand cars is 25%. And obviously, car prices aren't going to go up by 25% per annum indefinitely. So by the end of this year and into the beginning of 2023, we expect inflation to come back down to that target level of 2%. Now, one of the impacts of Ukraine perhaps is that the pace of interest rate rises will be somewhat slower than it would have otherwise been. And that's probably good from a property investment market perspective, because there would have been a yield impact. All that said, there is huge risk around this, a huge degree of uncertainty. This is our base case, but as we've seen recently, things can change quite quickly. Okay, let's turn to the property market, starting off with looking at the aggregate levels of investment volumes that we saw in the UK. And that figure for 2021 was £60 billion. So pretty strong relative to those record lows that we saw in 2020, unsurprisingly, because we were in the height of the pandemic. Our expectation is that we will see a 13% increase in UK investment volumes over the course of this year. And our forecast currently stands at £68.5 billion. So there are a lot of buildings out there, a lot of potential investors across a really diverse range of locations and a really diverse range of asset classes as well. We have recently conducted a survey of investors across EMEA. It's the EMEA Investor Intention Survey, and we've split out the UK results from the rest of Europe. And it's really quite notable about how much more positive the UK-focused investors are than they are for Europe in general. And as you can see from this chart, the expectations are for this year that we'll have both more buyers and more sellers as well. Again, this is just underpinning the reasons why we're expecting this year to be a pretty good year for the investment markets across the UK. And the really interesting thing about the way the UK investment market has developed is the way in which the profile of the kinds of buildings has changed. If we looked at where we were 10 years ago, so in 2011, 70% of all investment transactions were either for retail property or for office property. If we flick to what happened in 2021, only 40% of the investment transactions were focused in either retail or in office property. Clearly the big winner there in 2021 was the darling of the sector, the industrial and logistics market. But really, as you can see for our expectations for 2022, is we expect a significant diversification of investor appetite for different asset classes. The winners will obviously be logistics again, but we're also looking at the hotels market, the maturing build-to-rent sector as well. There is a lot of interest in alternatives, as backed up by that video from our colleagues on the investment side in Northern Ireland. And again, just turning back to this investor intention survey, the UK respondents are on the right there. I thought it's pretty interesting that despite some of the nervousness about the future of the office, offices came out on top as the #1 sector that investors want to put their money in. So I gain a lot of confidence from this. Investors putting their money where their mouth is, they believe in the future of the office, they're willing to invest in the future of the office as well. So really interesting there. And again, for the third time I'm going to say it, unsurprising that industrial and logistics is likely to see a lot of investor appetite over the course of this year. Now let's just look at the sectors one by one, and this chart here is our forecast of online penetration as a percentage of retail. You'll see what happened to the history of that. During the lockdown, it spiked up sharply. People weren't able to go to physical shops, they moved this to online. This wasn't a permanent shift, it was a temporary lockdown measure, and it did come down, but the level it came down to was higher than it was pre-pandemic. And this is the basis of our forecast. We expect a gradual increase and likely to go over 30% of all retail sales over the next couple of years. And why is this important? Well, it's the reason why logistics take-up across the UK has been so robust in recent years. Both 2020 and 2021 saw over 40 million square feet of over 100,000 square foot logistics units acquired by occupiers. And who's been taking that space? Well, the sectors are shown there on the right-hand side. 40% was online retail, 31% was third-party logistics. And a significant proportion of that third-party logistics is there to support the online shopping as well. So that sector is the reason why logistics is so popular, but I'm probably not breaking any news to anyone that anyone doesn't already know. And what's the impact been on yields? Well, unbelievably stark. Over this period, logistics yields have moved from by far the highest of any asset class, right down to the situation whereby the difference between central London office average yields and UK logistics average yields is virtually nothing. So this is a paradigm shift in the market, and something that would have been unimaginable 10 years ago, that a logistics unit would be yielding the same as central London office property. It's just one of the changes we've seen. Now the flip side to this online retail story is that bricks and mortar retail has undoubtedly been through a period of quite a lot of difficulty. I'll stop short of saying crisis. Prices have corrected over the past couple of years, but the result of this is that there's now significant opportunity for investors. And again, in the video, we saw a number of really important things happening in Northern Ireland, and that's mirrored across the whole of the UK. Investors are now starting to look at retail, seeing that they look like they're offering quite good value, especially when compared to logistics, and there's room for growth there. One way in which the retail investment market has changed is the type of retail property being sold. We've moved on the pre-pandemic levels for shopping centres and high streets dominating the market to retail warehouses and other types of less traditional retail really being more popular. And we would expect that to continue. For the residential market, again, this is a chart that we saw onto the video, and this has really matured into a proper asset class, which is popular with institutional investors, hitting record levels, and we expect the demographics in the UK in general, and specifically in Northern Ireland, to be really supportive of this institutional grade rental residential property. So again, keep a close eye on what's happening in that sector, because it's bound to be big over the next few years. Finally, turning to the office market, and it's really pleasing to see how attitudes towards the future of the office have changed. I've got charts showing two different surveys here. The one on the left is our EMEA Occupier Survey from 2020. The one on the right was the same question in 2021. The question was along the lines of, what do you expect to happen to your occupational footprint over the next 3 years? Now in 2020, you can see that the vast majority of the occupiers surveyed said that their footprint was going to shrink by more than 30%. And none of the respondents said that their footprint would either stay the same or get bigger. Now, this was so worrying to us that we didn't even publish this survey. Flick to 2021, and you can see how attitudes changed. When people were asked this question in the height of the lockdown, they couldn't see beyond it. Once things started to improve, all of a sudden they were able to get a bit more clarity, and the vast majority of them were saying that their footprint is going to stay the same, and an increasing number are saying that actually it's going to significantly increase. Our 2022 survey is currently in the field, and I would be shocked if there isn't further movement to the right here. And it's looking likely that the questions about the future of the office isn't dead, questions about the future of the office are dead. And we can look at the take-up figures that we've seen. Clearly, it's been very weak across the UK. This chart shows the cities that we cover outside of central London and the southeast. So it's pretty weak in 2020. It did see a notable improvement in 2021, but still below average levels. Our expectations are that as people return to offices, as occupiers are able to properly implement their occupational strategies, we should see above average levels of take-up in 2022. Now, that covers everything I wanted to talk about. It's perhaps notable that I didn't mention one thing here, which is the most important thing according to occupiers and investors at the moment, and that's ESG. And the reason I didn't mention it is because we've got a film talking about it now.